back up. So, you know, this is already a portfolio we built, and it beat the S&P 500 by a large margin. And maybe we just got lucky, right? Maybe it's just lucky. This is you're just lucky drawing. So we're gonna rebuild another portfolio, right? We're gonna rebuild another portfolio, and this time we're gonna go, more heavy on technology, right? We're gonna say, you know what? I'm gonna take a gamble, and I'm gonna think that technology is the place to go. So I'm gonna get Microsoft. Right, I'm going to keep Palo Alto Networks. I'm going to get Microsoft in there as well, right? And I'm going to have Adobe, I'm going to put Adobe in there. So I'm going to get rid of McDonald's. I'm going to get Adobe, right? Put some Adobe in there. Right, you got some Adobe, and you got to have NVIDIA. We're going to put some NVIDIA in there, so we can get rid of Walmart, put NVIDIA in there, and we're going to put some AVGO in there. So we're going hard in the paint with a technology portfolio. We're going to go with AMD as well. Right, AMD. We have Broadcom already in there. We have AMD. Right, we're going to go with Apple. Because Apple, you gotta have Apple, right? Apple's. I'm gonna put Apple in there. All right, and our diversified is going to be a theme base. We're going to have a themed based portfolio that's just hard in the paint in technology. So we're going to go ServiceNow, right? That was one that popped up. So what is it now? ServiceNow. Pick that one. What's this one? Roper. We're going to go with Uber. No. We're going to go with Dell. No, we're gonna go with Dell. We're gonna go with Dell computers. Dell. Throw some Dell in there. And we need one more. I guess we could go with. I guess we could go with ACN right here. ACN. Right. So this portfolio is just hard in the paint, right? It's hard in the paint, straight up technology portfolio, right? And it's diversified with 10 different companies, but it's all in tech, right? It's a tech portfolio. And some people would say, well, you're better off, right? Why don't you just go with, XLK, right? Yeah, XLK, right? Technology sector. Or they might say go with QQQ, right? So let's just compare. Let's see what happens, right? So, we're going hard in the paint on these technology companies. We're diversified into 10 different companies, and we're going to do that. We're going to own the companies instead of just owning some ETF, right? And we're going to compete against Vanguard, and we're $200 a month, right? Every month. And remember, our golden goose is rebalancing, so we're going to manage the portfolio through rebalancing, not just selling companies. We're going to hold on to them and rebalance them. And we'll see how it works out, right? Let's see what happens. So, Dell is relatively, it came back on the market, and so it started. It's not a 10-year, but it's close enough. We'll see how we did, right? Let's see how the portfolio handled. right? So this is our portfolio. We made $85,600, right? And we just randomly picked our stocks in the tech sector, and we completely, more than doubled the S&P 500 guys who are Vu and Chill, and say that, well, it's impossible to beat us. But I mean, in 9 years, we more than doubled their money, right? And the QQQ guys, yeah, they beat the S&P 500 guys, but I mean, we beat them by $38,000, right? And the tech one, XLK, right? It made 50K, 51, to our 85, right? You don't want that one? Yeah. Okay, we'll put it up. So, we just completely smash these guys, right? And it's just random, right? And we can go and we can look at our portfolio and we can see what companies performed well and what didn't. And of course, looking at this doesn't really matter, right? Like we could say like Adobe, right? Like, here's Adobe, right? Maybe Adobe, it didn't return very well. Well, maybe if it was in a different portfolio in the same time frame, it might have performed a lot better. But because all these other companies performed well, maybe that's why this one didn't. It just didn't perform. It didn't synchronize well with the portfolio. But that doesn't mean that you need to get rid of it, because you might not see that it's over time, you might not see that it's just an anchor. It's just a hedge to volatility. You don't know what it is, right? You don't know how it plays out in the complexity of the actual portfolio itself, And so the reason you just keep them equal weight is so that right there is how you balance it, right? It just keeps it balanced. You just want to balance it out, right? So remember this Adobe Systems, right? This Adobe performed, it was like the worst performer in this portfolio, right? And of course you had an outperformer with NVIDIA, and look at Broadcom, right? I mean, you look at Broadcom here with $10,800. That's a outperformer. Look at Dell. I mean, even Dell had pretty good performance, right? But Adobe, you're like, well, why would I invest in that, right? But you don't want to get rid of Adobe, just because it didn't perform well. It might have been you just don't know how it interacted in the complexity of all the companies combined and the rebalancing, right? Adobe's still a good company. I'm going to get you.